Dear learners, today I'm going to explain one trade which has a potential to give even 100% of return. Well, you must be wondering that I usually don't believe or don't give trading tips. So why I am making this video? There are two reasons. One, I want to highlight the difference between investing and trading. Obviously, this course which we are doing, a complete course on Indian stock market, is dedicated both on investing and trading, but I am a firm believer of investing, where I want all Indians or every Indians who have savings to dedicate some of their saving into capital market by investing into good companies. So this is one reason I'm making a video on trading also, because a lot of people are interested into trading. They end up using different trading techniques and lose a lot of money. And obviously some of them make money also. We do have trading modules in our course, but there are different situations also which can be used as trading techniques to make or generate a certain amount of income. So idea is to highlight the difference between investing and trading, that when you think about trading, how do you cover the risk which you are going to take into that trading or any trade. So this is also one trade where market risk, industry risk, and even the company performance risk is automatically covered to a great extent. So this is the reason one. Reason two is, this is not a trading tip. This is more of a market inefficiency, I would say. It's a very large company, big company of India, one of the company belonging from a very reputed business house, one of the oldest and reputed business house of India. And yet a big inefficiency is going on right now into the share prices. And you can take an advantage of that inefficiency and generate some wealth, income for yourself. So that's the only two reasons why I'm making this video. Whether you take a trade on this or not is completely your responsibility. I'm not your investment advisor. My job is to teach you things. And here I'm going to teach you about 2-3 concepts. One is called DVR. What is DVR shares? So that will be covered. How 3 different risks are automatically getting covered into this trade will be also explained. What is the different market efficiency? And finally, how you will make money in which kind of situations is what it will be explained here. Well, to understand the trade, let's go to the screen. So let's see the trade now, and I have calculated it on this Excel sheet. So the trade which I'm talking about is about this company called Tata Motors. So first let me explain the trade, and then I'll explain you the risk factor and return also. So here is the trade. Trade is, you have Tata Motor normal share trading at 182.25, and you are having this Tata Motor DVR, which is another type of shares in Tata Motor itself, trading at 75.75. I have taken this from Google Finance. If you go to Google Finance and see the normal trade here, 182.25 is ordinary share, fully paid ordinary share, and differential voting right share is trading at 75.75. Before we go to the Excel sheet, let's see something. So you can see this date. Let me expand it, and here you see on 7th November 2008, Tata Motor DVR was trading at 47.70. Let's see on the same day how much Tata Motor normal share was trading. So in November, 17 October, 31 October, 14 November, it is trading at 27.14. Maybe on 7th November a little higher, anything between 31 to 27, let's say on 30 rupees. So what you can see that in November 2008, Tata Motor normal share was trading at 30 rupees and DVR was trading rather at 47.70, which means DVR, another type of shares in Tata Motor, was at a premium. It was getting traded at the higher price than Tata Motor normal share. Now you see that this is one instrument which was getting traded at a premium that time 10 years back, and right now it is getting traded at discount. So right now normal share is 182 rupees and DVR is 75.75. So here the inefficiency which I find in market is that Tata Motor DVR is highly discounted. I'm not using the word undervalued or overvalued. We are not doing a fundamental analysis here. The word I'm using is highly discounted. So the opportunity is buy something which is highly discounted and sell something which is not discounted or which is trading at premium. Since both of these shares represent the same company, rather in DVR, when company is distributing more profit or distributing profit in form of dividend, they will give more dividend to DVR as per the nature of the stock. I think by definition 10% higher dividend on the Tata Motor. However, you still need to check this. I'm not very sure about this part, whether it's 10%, 5% or 20%, or there is any variable clause added there. For that, probably you need to write to Tata Motor that what are the terms and conditions at which they have issued the DVR. Another condition or term which I'm aware about is in Tata Motor DVR, the difference is that though you will get more dividend when company distribute dividend, but you will not get equal amount of voting rights. I think out of 10 DVR shares, you will be given the voting right of 1 share. But you being a retail customer, do you really need to use these voting rights? Or whatever the shares you are holding till now, did you ever use the voting rights? So in a country like India, we hardly use the voting rights, and company issue DVR kind of shares in India or in US, they are called C category shares, is to make sure that they are not diluting enough voting rights and keep most of the rights with them so that they can function the company smoothly. Okay, they can safeguard themselves against hostile takeovers kind of situation as well. Well, this is not a fundamental analysis. This is an analysis where I'm showing you one efficiency which you can use provided you are ready to take some risk also, because there is no trade in this world which don't come with risk. There are risks. However, when I'm explaining you this, I'll also explain what are those risks, and in few cases or if few risks are automatically covered in this trade. So let's see very carefully. So the trade is, since DVR is highly discounted, I will buy that. And since normal share is not discounted, or we can say trading at a premium from the DVR, we will sell that. Well, to take this trade, you don't have futures in Tata Motor DVR, so you have to buy the normal shares, and you have future for Tata Motor, so you can sell Tata Motor future. Obviously in India you can't short stocks, so to hedge this position, to manage few risk, which is market risk, industry risk, or even the company risk, you can short Tata Motor future. So what's the trade is right now? Well, since it is discounted and discounted at certain percentage right now if I show you here, the discounting formula I have applied, where I have subtracted from B2 minus B3 divided by B2 into 100. So you can see that Tata Motor DVR is trading at 58% discount, 58.43 discount. There was a time when it was trading at premium. Let's say I assume here that, okay, even if Tata Motor DVR don't go to the same position when it was actually giving profits and distributing dividends, and it was trading at a premium of the normal share, right? Let's say even don't go that situation, but what the situation stays is both of the prices merge to each other. So let's say if that merging happens, it can happen in two ways. What could be the two way? Either this 182 comes down to 75.75 and this also stays at 75.75 and discounting becomes 0. In that case, you make a profit of approximately 6 lakh rupees. Okay. Another way, it can go to 182.25 and this also become 182.25. Yeah, 182.25 means again zero discounting, so similar kind of profit you make. Well, I'm not saying that Tata Motor may go to 400 and DVR may also go to 400, and then again you can make a similar kind of profit here. In this case, we have done the hedging by shorting Tata Motor future of three types. One, let's say if market falls from here, so every other stock will fall, and if every other stock will fall, maybe few times back Tata Motor was also trading at 50 rupees, so both of these shares come to 50 rupees and you still make that 6 lakh rupees profit. Let's say overall market stays constant, but then industry falls, and because of that there is, the auto industry as a sector fall from here, and still both of these prices can converge together and come to any level, and you can make a maximum profit of 6 lakh rupees. Or even company has done really bad, and the Tata Motor shares comes down to 0 rupees. Even in that case, you end up 6,07,000 rupees, 6,07,050 rupees. What I'm trying to tell you that since you have shorted Tata Motor future up to a great extent, even if market falls or overall auto sector falls or company falls, what will happen here is you will be only dependent on one thing, which is like how much they converge together. So the fundamental thing is, since something is 58% discounted, this discounting will get over in some time. Maybe not many people are right now focusing on Tata Motor DVR. If I am one value investor into Tata Motor, I would prefer buying Tata Motor DVR and not prefer buying Tata Motor normal share at this point of time, right? So maybe one good trading session and many people realizes this as an opportunity, and this gap become narrower. It don't stay at 58.43. What else can happen here? Since I am hedging it by quantity, and 5700 quantity I have taken only because of one reason, that Tata Motor future lot size is 5700. Hope people who have covered the derivative module in my course, they are aware about these concepts of future, about hedging, about these kind of risk. But if not, you should go and revise the risk management chapters in derivative market. Well, so this is the case where you are going to hedge by quantity mentioned in Tata Motor future lot size. Capital requirement, Tata Motor future position 35% total margin right now is required. That will come around 3,50,000 rupees. To buy 5700 quantity of Tata Motor DVR, you need to deposit 4,31,000 rupees. Overall, you have 7,81,775 rupees requirement of capital to execute this trade. If something goes wrong and margin calls come, obviously you have to top up with that as well. And if I go and take this favorable situation, you can see that the percentage return can go to as high as 77% against the capital which you have used. Well, this is where we are hedging by quantity. Now there is another situation. You can also hedge by value. So what is the hedging by value? For short term, this discounting may not go and become narrower. It can, I can take another situation. Maybe one day you don't want to wait till 182 and 182, and it can come to 150. This can come to 60 or 90, let's say. Discounting is still 40%, and still you make 2,65,000 rupees. Well, people who do statistical arbitrage, they will be able to also take such pair trade where they always buy DVR and sell Tata Motor future, but that discussion we'll do some later, some other time in another video on a statistical arbitrage. But here you can see even in this situation, one person can make 33% return against this capital. Well, there is another way you can also do the hedging. And how is that way? you can hedge by value. So since you are shorting Tata Motor future, you can think about buying the similar value of Tata Motor DVR, and results will be much better than even the previous strategy where I have shown you certain return, which is like 200 and 200, and then the maximum return is 6,07,000 rupees. Here what can happen is, let's say both of them goes to 182. What you can see here is 14,57,000 rupees is the profit you can make if you go and hedge by value. But obviously here you have to deploy more money, since DVR shares, if you're buying 13,700, which means you're trying to make sure that the value of the future you have shorted and value of the DVR holding you have taken are equal. So that comes to around 13,88,000 rupees, which makes the return to 104%. You can try different market, different permutation combination. You may define your expectation also, that since this kind of gap is present, what kind of benefit you want to take. Someone may be happy with even 10% return if they get it in 5 days, and again retake the trade when the discounting goes over. Someone may just go and stand there for an year in anticipation that this all discounting get over, and he makes good money and a good return. And there will be certainly risk also. This discounting can go bigger. So right now it is 58.43%. What if this discounting goes to even 65%, which means that this become 200 and 65 means this stays at 70 rupees only. I mean, it falls by 5 rupees and this goes up by 18 rupees. Well, in this case, you can see you can make a good loss of 1,33,000 rupees also. Can this discounting go 100%, where this goes to 200 rupees and this goes to 2 rupees, and you make a loss of 5,21,000 rupees? I have no answer for this. Okay, every trade is having a risk. My idea is here to warn you against all kind of risk. Can anything happen in the market? Yes, anything can happen in the market. If the discounting can come to 58%, can it go to 90%? Nobody knows. Okay, I don't know. Tata Motor must know this. The management of Tata Motor must answer this, that why their share is trading at so much of huge discounting. Even if you go and Google about this case, nowhere, nobody has explained, either from the management or anywhere, that why this kind of heavy discounting is going on. What I feel that this is a price, or this is a situation where already discounting is very high. I would be very, very positive if I'm going to take this trade, and not think that this discounting is going to go by 99%, but rather this discounting will get merged and give a good return to people who are trying to take a benefit out of this unusual scenario, this inefficient way how this stock is trading. Idea was to explain you one trade, and also to explain you that there are enough number of market efficiencies always playing out in market. All you need to do is go and track them and use them in your benefit. This is one of the most robust way of doing trading, finding the inefficiency in the market. I'll also keep on searching such kind of inefficiencies. I know for many retail traders, this capital of 8 lakh rupees or 14 lakh rupees will be high to enter into trades, but certainly HNIs or people who have a good appetite. One of the reason also I made this video, that people who have good appetite of taking risk. So see, I'm really worried if someone is just having 20,000 rupees and he loses it. But people with a 1 crore portfolio, 50 lakh portfolio or 2 crore portfolio, money is also a value for them. I'm not saying that their money comes without hard work or they must take risk. Okay, but still people who have, according to me, a good capital can probably think about allocating few percentage of their overall capital in finding such opportunities where they see that inefficiency in the share prices. There are different trading techniques where these gaps can be identified, where you can short one stock and buy another stock from the same sector, which is called pair trading. I will discuss about that as well in some other video. But for now, please comment and also read the description which I'm going to put across in this video. Maybe I'll put the link of somewhere so that you can download this video also, this Excel sheet also, for your future use. So that's it. This is all I wanted to explain. Please don't consider this as an investment advice. This is purely for educational purpose, where I wanted to explain you DVR concept, where I wanted to show you a case where inefficiency is there. Okay, so be very, very careful when you are thinking about trading. And that's it. I hope I have not done any mistake in terms of explaining this situation or scenario. I always refrain from giving tips. I don't consider this tip, by the way. This is one unusual scenario which I wanted to explain to all my learners. Hope you understood it. If not and have any question, you can comment and I'll answer that. And also read the description. I'll somewhere put the link. Thank you. Thanks a lot.